October 19th, 1987. New York City. The trading floor was not loud that morning. That is what people get wrong about crashes. The noise comes later. In the early hours, there is a strange, disciplined silence. Phones ring. Screens flicker. Orders hesitate. Prices gap lower without resistance. I remember watching seasoned professionals stare at terminals, realizing at the same moment that liquidity had vanished and certainty with it. Outside the building, an office worker named Mark Sullivan was buying coffee before work. He had been investing his savings diligently for years. Mutual funds, retirement accounts, long term. By the time he finished his shift, the market had fallen over 20% in a single day. His statements still showed balances. His confidence did not. I begin here because financial secrets are not hidden behind locked doors. They are hidden in plain sight, protected by social norms, shame, and silence. The most powerful ones are never spoken aloud because speaking them openly carries a cost. I have survived multiple crises not by predicting crashes, but by understanding what cannot be said publicly by those who manage money at scale. These are not tricks, they are structural truths, and they are kept quiet for a reason. The first thing you must understand is this: the financial system rewards conformity and punishes deviation until it doesn't. The people who outperform over decades do so by quietly positioning against the consensus while appearing compliant on the surface. This has always been true. In the late 1920s, bankers privately reduced exposure even as they publicly encouraged participation. In the 1970s, institutions quietly moved capital into hard assets, while households were told inflation was temporary. In the late 1990s, sophisticated money sold technology shares to the public while maintaining plausible deniability. This is not conspiracy, it is self-preservation. I learned early that the most important financial truths are socially inconvenient. They challenge narratives people need to feel safe. They imply that following advice too closely is dangerous. They reveal that systems are designed for stability, not for your prosperity. This has happened before. It follows stages. First, a dominant narrative forms. Growth is permanent. Risk is manageable. Volatility is an opportunity, not a threat. Participation becomes moralized. If you are not invested, you are irresponsible. Second, leverage increases quietly. Not just financial leverage, but psychological leverage. People commit future income to present expectations. Retirement assumptions harden. Lifestyle inflates. Flexibility shrinks. Third, silence sets in at the top. Those closest to risk reduce exposure incrementally. They do not announce it. Announcing it would move markets and destroy their own exits. So they remain calm in public and cautious in private. This silence is the first secret. Most people believe financial success comes from access to information. It does not. Information is abundant. What matters is permission. Permission to act differently without social validation. In Weimar Germany, families who quietly converted savings into hard assets early were mocked. They were accused of disloyalty. By the time their neighbors followed, conversion was impossible. In Zimbabwe, those who moved wealth outside the banking system early were labeled paranoid. Later, they were the only ones with options. Silence protects early movers from social pressure. It also protects them from being copied too late. The second secret is harder to accept. The system does not want you to understand it fully. Not because of malice, but because mass understanding would destabilize it. Debt-based systems rely on participation. If too many people opt out, liquidity collapses. That is why certain ideas are discouraged. Holding cash alternatives, avoiding excessive leverage, measuring wealth and purchasing power rather than nominal returns. These ideas are not illegal, they are simply not promoted. I have watched generations be taught to speak openly about goals, plans, and portfolios. This is framed as transparency. In reality, it is vulnerability. The more predictable you are, the easier you are to manage. The most effective investors I know speak less as their understanding deepens, not because they are secretive by nature, but because they recognize the cost of being early and visible. There is a reason elite capital moves quietly across borders before crises. There is a reason balance sheets change before headlines. There is a reason the most important reallocations never trend. The title of this discussion is uncomfortable for a reason. Financial secrets are not about hiding money. They are about protecting optionality in a world that penalizes independence until it needs it. In the chapters ahead, I will lay out 5 truths that serious investors learn and almost never broadcast. Not tactics you can copy tomorrow, but principles that explain why outcomes diverge so sharply between those who appear to play the same game. These are the things said privately over years, not loudly on television. I am not here to provoke. I am here to explain why silence, at critical moments, is not cowardice. It is strategy. Because by the time a financial truth becomes popular, it has already stopped being useful. The first financial secret is deceptively simple. Liquidity is more valuable than yield. Always. And yet, it is rarely treated that way publicly, because admitting it undermines narratives about growth, bonds, and safe income streams. I learned this the hard way in the 1980s, during the Latin American debt crisis. Governments were defaulting quietly, interest rates spiking, and the world still believed emerging bonds were safe. They were not. Those who prioritized liquidity over nominal returns survived. Those who chased yield were wiped out. Liquidity is not about panic. It is about optionality. The more you can move, convert, and redeploy capital at a moment's notice, the more power you have to act when the system changes direction. Cash is a simple proxy, but it is not the only form. Gold, foreign-denominated deposits, assets that can be sold quickly, all of these are forms of liquidity. History proves the principle repeatedly. In Weimar Germany, those who could convert marks into foreign currency or hard assets did so quietly. By the time the hyperinflation became obvious to the masses, their neighbors were trapped holding currency that became worthless. In Zimbabwe, during the 2008-2009 collapse, liquidity in small transferable units, fuel, foreign cash, and basic commodities became far more important than local bank balances. Those who understood this principle could continue functioning economically, while others were paralyzed. This secret also explains a subtle behavioral truth. Everyone else will overcommit to illiquid assets at the wrong time. The public is taught to invest in stocks, bonds, and pensions. Institutions compete for performance metrics tied to illiquid instruments. When the crisis comes, these assets cannot be sold without significant loss, often precisely when the liquidity premium spikes. The difference between survival and ruin is timing and flexibility, not skill in predicting the market. A common objection arises here, but liquidity pays nothing. It is boring. You miss upside. That is exactly the point. Yield without optionality is a trap. If you can earn slightly less today, but maintain the ability to redeploy your capital at the right moment, you gain far more than the nominal return suggests. Those who ignore this during stable periods inevitably pay the price during stress. Portfolio positioning is subtle. One need not hold 100% liquid assets. In fact, doing so invites opportunity cost and complacency. But the allocation must be sufficient that, at the onset of stress, you can move quickly, buy what others cannot, and exit situations where losses are guaranteed. This is the essence of optionality: visibility without exposure, action without friction. There is another layer most investors ignore. Liquidity is a relative concept. It is not absolute. Cash in a local currency may be illiquid if the banking system freezes or the currency collapses. Gold or foreign accounts may be the actual liquid instruments. During Argentina's Corralito, domestic deposits were frozen. Those with foreign liquidity were effectively untouchable. The public, chasing domestic yield, had no escape. The most critical insight here is psychological. People overvalue nominal returns because it is socially praised. A certificate of deposit earning 3% sounds responsible. A foreign currency deposit earning 1% sounds timid. But when crises strike, the first generates panic and loss, while the second maintains optionality and control. Silence is strategic. Those who act quietly, preserving liquidity, survive. This is the first secret you must internalize. Liquidity is a protective asset, a tactical advantage, and the currency of optionality. It is boring publicly, but lethal privately. It is the first layer in every elite investor's strategy, before risk is taken, before allocation decisions, before yields matter. In the next chapter, I will reveal the second secret: why owning real assets, physical, productive, and externally priced, is the most overlooked way to preserve wealth in silence. Here, the system's design punishes those who ignore this principle, while quietly rewarding those who understand it. The second financial secret is the one most disguised by conventional advice. Own real assets that produce essential goods or services and have pricing power outside the system's control. It sounds simple, almost obvious, but it is systematically obscured in the mainstream. Why? Because teaching this openly would undermine consumption-driven markets and centralize monetary control. Those who understand it act quietly, positioning themselves in ways that cannot be copied at scale. I first saw this pattern in Argentina, 2001. The peso was collapsing. Banks froze deposits. Salaries lost value almost daily. People panicked over cash they thought was safe. Meanwhile, farmers, small energy producers, and essential goods merchants, those who controlled production rather than just claims on money, were thriving. They were not celebrated. They were ignored. But they had a structural advantage. Scarcity and necessity guaranteed demand. Their real income did not depend on currency value. The mechanism is subtle, but powerful. Real assets produce goods or services that society cannot postpone consuming: food, energy, water, shelter, healthcare. When currency fails, the price of these goods rises, sometimes dramatically. The nominal gain in currency terms is obvious. What is less obvious is that these assets continue to deliver real purchasing power regardless of what the central bank does. They are insulated from monetary dilution. History is full of examples. In Weimar Germany, industrial land and farms remained valuable even as Marx collapsed. Urban cash savings evaporated. Those who held assets producing essential goods could survive, feed themselves, and even profit quietly. In Zimbabwe, commercial farms with operational control became islands of stability. Outside the currency, outside the banking system, real production was the only currency that mattered. In Venezuela, energy infrastructure and small-scale commerce remained operational, while the majority of financial claims were worthless. The critical insight is this: ownership alone is insufficient. Operational control matters. You do not benefit if you own an asset theoretically, but it is mismanaged, illiquid, or politically confiscated. Many investors bought farmland, factories, or energy assets during crises expecting nominal gains. They ignored local controls, governance, and management. Their positions became liabilities. Those who exercised control, diversified revenue sources, and retained autonomy thrived. Illusion is common. A stock price may rise in local currency, but if the currency collapses or markets freeze, it buys less than before. Nominal returns are not real returns. Real assets producing essentials maintain real value even when financial claims collapse. This is why most people chasing paper wealth are surprised when they go broke, while others quietly prosper. Portfolio allocation here is strategic. One does not need to own all sectors or every commodity. Focus matters. Necessities that cannot be postponed, assets that have external pricing, and production that generates cash flow without dependency on fragile systems. Exposure should balance survival, growth, and operational flexibility. Too little, and you are vulnerable. Too much, and you become visible, over-leveraged, or politically targeted. Psychology is the hidden force. People dismiss essential assets because they are not glamorous. They chase tech stocks or bonds with fixed yields. They believe sophistication equals safety. Real production is humble, slow-moving, and unsexy. But when the system stresses, it is unshakable. Those who ignored it pay the price. Those who respect it profit quietly. The secret is reinforced by silence. Elite investors rarely broadcast operational positions. Doing so invites competition, regulation, or political attention. They act privately, quietly shifting resources into productive assets with pricing power. The public hears only whispers or post-facto anecdotes. This is the second secret. Real assets with operational control are wealth insurance and strategic leverage hidden in plain sight. They survive system distortions that destroy nominal wealth elsewhere. They produce tangible value that cannot be confiscated easily, borrowed against, or rendered irrelevant by policy shifts. In the next chapter, I will reveal the third secret, how positioning across liquid and real assets, combined with timing, creates asymmetric optionality that most investors cannot perceive, and why this separation explains the extreme divergence in outcomes during every major financial crisis. The third financial secret is the most subtle and at the same time the most powerful asymmetric optionality through the combination of liquidity, real assets, and timing. It is the principle that allows a small, quiet position to survive and often profit when the majority collapses under stress. Most investors never see it because it is invisible until the system is stressed. By then, it is too late. I first observed this in Latin America during the 1980s. Hyperinflation, political instability, debt defaults, they were all happening simultaneously. The public panicked. Bank deposits became worthless. Wages could not keep up with daily price changes. But a few operators who had quietly maintained liquidity, invested selectively in productive assets, and timed their purchases across borders, thrived. Their positions were asymmetric, small losses if the system normalized, enormous gains if it collapsed. The key mechanism is optionality. Optionality is not speculation. It is a structural positioning that allows capital to benefit from stress without overexposure. A real estate holding in a currency-hedged market, a small but operationally controlled farm, a foreign currency account, each alone may appear conservative. Combined strategically, they provide a bridge across stages of instability, a ladder from normalcy into crisis. History reinforces the lesson. In Weimar Germany, those who held foreign currency, operational land, and portable gold simultaneously were insulated from market collapse. They did not need to predict the exact moment or sequence. They only needed to maintain positions across layers of vulnerability. In Zimbabwe, the few commercial operators who combined cash reserves, functional farms, and externally priced commodities survived while everyone else starved. In Venezuela, entrepreneurs with cross-border exposure and essential services were able to operate in ways the local banking system could not. Optionality also requires discipline. Many investors mistake leverage for optionality. It is not. Leverage amplifies risk when the system moves against you. True optionality is quiet, defensive, and scalable. It provides asymmetry, maximum survivable upside, minimal forced downside. This is why silence is critical. Signaling your positions reduces the advantage. Those who broadcast intentions are copied too late or targeted politically. Illusion is everywhere. Nominal gains in local markets are meaningless if the currency collapses. Stock indexes can surge, while real purchasing power declines. Bonds may yield safe returns, while liquidity evaporates. Optionality does not guarantee nominal gains. It guarantees flexibility, resilience, and access. Psychology is as important as mechanics. Most investors cannot tolerate being underexposed to apparent opportunities. They fear missing out. They over-leverage or chase nominal returns. Optionality requires restraint, patience, and humility. You must accept modest returns in calm periods to survive and capitalize during crisis. Portfolio design here is tactical. You maintain liquidity to act quickly. You control essential, real assets to survive system shocks. And you position selectively for asymmetric payoff scenarios, ensuring that when the system tilts, you are among the few able to act decisively. Timing matters less than preparedness and positioning across vulnerabilities. The system is designed so most will fail precisely at this stage. Social pressure, behavioral bias, and delayed recognition keep the majority overexposed to fixed claims and underexposed to optionality. They are forced to sell at the worst moments, buy at the wrong time, and blame themselves. The truth elite investors understand quietly, without speaking, is that financial survival and wealth creation are less about prediction and more about structural alignment with how the system behaves under stress. Optionality is invisible in good times, obvious only in crisis. By the time it is obvious, you have already lost the advantage. In the next and final chapter, I will consolidate all 5 financial secrets. I will show how to combine liquidity, real assets, operational control, and optionality into a coherent, resilient framework. I will also reveal the subtle psychological strategies that allow elite investors to maintain this advantage quietly, while most others are swept aside by the system they trusted blindly. We arrive at the final convergence. All the lessons, patterns, and secrets align here. This is where preparation, discipline, and silent knowledge translate into survival and opportunity. The elite investors who thrive across decades do so not because they predict perfectly, but because they structure their lives and capital around principles that the system cannot alter. Let's start with the first secret: liquidity above yield. By maintaining ready access to capital, you ensure the ability to act when markets shift. This is not about hoarding cash, but about preserving options. Liquid positions allow you to buy distressed assets, reposition into productive sectors, and exit failing claims. Without liquidity, even the best insights are irrelevant. Second, real operational assets. Ownership must mean control. A farmland note is worthless if the farm is mismanaged or politically confiscated. A factory is only valuable if it produces cash flow and goods that society cannot postpone consuming. Essential commodities, energy, water rights, and productive real estate provide resilience when paper wealth fails. These assets reprice with the economy rather than lag it. Third, asymmetric optionality. True optionality is structural. It is about combining liquidity and real assets in ways that produce outsized survivability under stress. This is the bridge from calm to crisis. Optionality allows you to benefit when conventional markets falter, without betting everything on a single outcome. Leverage is not optionality. Strategic, quiet, diversified positioning is. Fourth, timing and patience. Crisis does not need prediction, it needs preparedness. The system signals stress before headlines appear: credit spreads, currency mismatches, yield curve distortions, and policy innovations. Those signals allow you to act incrementally, quietly, and ahead of the crowd. Patience in calm times is as critical as decisiveness in stress. Fifth, psychology and silence. This is the secret that ties the other 4 together. Speak too loudly, and you invite competition, regulation, and political attention. Reveal positions prematurely, and optionality evaporates. Maintain discipline, and your advantages remain private. Most of the system is designed to socialize risk upward and individual losses downward. Recognizing this, but acting quietly, is the ultimate safeguard. Portfolio construction across these principles is not formulaic. It is strategic. Maintain sufficient liquid reserves to exploit opportunity and navigate unexpected freezes. Allocate to operational, real assets that survive systemic shocks. Position selectively to preserve asymmetric upside, ensuring survival if the system strains. Observe signals and act incrementally. Don't overreact to noise, but don't delay on fundamentals. Protect the psychological discipline to act quietly and decisively, even when peers panic. Modern warning signs are abundant. Excessive global debt, negative real interest rates, credit expansion detached from productivity, and asymmetric monetary interventions are all signals. The system is engineered to maintain continuity, but continuity comes at the cost of redistributing wealth upward through these mechanisms. If you understand the structural incentives, you can navigate them. To skeptics, what if you're wrong? Even if systemic collapse does not materialize as expected, these principles are defensive and flexible. Liquidity provides optionality. Real assets preserve tangible wealth. Optional positioning mitigates losses in multiple scenarios. Silence costs nothing but reduces risk. The asymmetry favors the prepared. This is not theory, it is repeated history. Weimar, Zimbabwe, Venezuela, Argentina, Lebanon. In each case, those who understood these 5 truths, liquidity, operational control, asymmetric optionality, timing, and psychological discipline, survived. Those who ignored them lost everything quietly and convincingly. The final lesson is simple. The system is indifferent. It will redistribute wealth according to its design, not your effort. Your choices, quiet, disciplined, and structural, determine whether you thrive or are swept aside. The first hour, day, and month of systemic stress defines careers, retirements, and legacies. The ultimate call to action is calm, deliberate, and urgent. Assess exposure, protect optionality, control assets, and act quietly before the signals become obvious to everyone else. The system will not pause for understanding. It will not reward naive compliance. It will only reward those who see the architecture, recognize patterns, and position accordingly. The financial secrets elite investors keep in silence are not esoteric. They are structural truths revealed by history, enforced by the system, and exercised quietly by those who survive while most others do not. Silence is not secrecy. It is strategy. This concludes the 5-chapter series. If you want, I can now create a full YouTube-ready package for this script. Thumbnail prompts, tags, description, and cinematic scene breakdowns for each chapter to maximize engagement and retention.